Okay, welcome back to the podcast. My name is Doug Sandler. That is me. That guy over there, the better looking guy of the two of us, that is Mr. John Browning. And this is great that we're on a podcast. This is audio. Well, I don't know. You post this on YouTube too, don't you?
It's on YouTube too. Yeah.
Oh, gosh. Well, so then it's a fashion contest. I'm always wearing a t-shirt. That's me. You got a collared shirt on. You're always looking better than me, John. What's up with that? Welcome back to the show. Thanks for being here, man. I love this is one of the spotlights in my month. So for those in our listening audience, we tend to batch record things. John and I spend about an hour and a half together doing these podcast episodes, and it's a chance for me to laugh a little bit about sometimes a sad situation in the state of affairs in the world and the economy and all of that. But look, if you can't commiserate with somebody that's in the know, then who can you commiserate with?
Oh, that's right. And hey, at least I don't have a suit and tie on. That would be
Now, how
that
many
would be
years did you dress in a suit and tie?
30 plus.
Oh my gosh.
Every single day I went to work and sometimes on the weekends. Yeah, it was I'm
And
just fine with rarely getting into a suit and tie now. Now that may cause me to lose some clients. And you know what?
it's
That's all
you
right.
know what? I think the guy that's still wearing the suit and tie, I think that he is the one that probably has the outdated strategies. I'm gonna say that. I'm gonna go out on a ledge there by saying that. But I am not saying if you wear a suit and tie that you're an out of touch, out of character person. I'm just thinking that is that how we are anymore? Do people wear tuxedos and jackets and ties anymore?
Maybe somewhere.
I don't
Maybe
know.
somewhere. Now every once in a while I do like so there's a meeting once a month I go to that I wear a suit and tie to because that's kind of what's expected. And it's a breakfast meeting, and by 10, 11 o'clock, that suit and tie is gone.
I
So
bet. I bet. Get out of that. I get out of my street clothes and into my pajamas again as quickly as I possibly can here. As a podcaster, I've been a podcaster for almost 10 years now, and I joke around. I very rarely even have to put on pants. So, so for me, I
okay,
I
don't stand up.
I won't. I won't stand up to say goodbye to you. So you have an interesting topic that's on the board today, and it is one that is near and dear to my heart because I have to say in the past that this has happened before, and I'm sure that there are many people that are thinking this now. If John is not your advisor, or the guy that you're being held accountable to or with, it may be interesting. It's an interesting question to ask. The question is, the market is up 20%. Why is my account flat? Great topic. I want to talk about it. I'm just going to give you the intro to this, and then I want you to kick it off from there. John, the market's up 20%. Why is my account flat?
Well, what's your long-term strategy?
Oh, love that. Love that
so and
question.
so I completely get this, and there are some of my accounts that are up. Like right now as we're talking, though, the market meaning S&P 500 equity, straight equity,
Right.
no downside protection, right? None of that. It's up, somewhere in the neighborhood of 18 to 20%. I have clients that are up roughly that for the year.
Yep.
I also have clients that are up like 1, 2%. And I also have clients that are up maybe 8%. I don't have anyone this year that is negative. So that's a good thing. Uh,
So,
but but there may be because that might be their strategy and what they're doing with their portfolio and what their best life entails, which might be maybe it's a very conservative strategy. Although, interestingly, over the last 2 years, many people who thought, and I put that in air quotes for those of you not watching on YouTube, you thought you were a conservative strategy because you had that. We talked about this, was the last week or week before, that outdated strategy of a 60/40 portfolio.
mm,
That was supposed to be somewhat conservative. The crazy thing is, US Treasuries, 20-year US Treasuries, if you look at that market, it's down
wow.
60% over the past 2 years. So if you're in that 60/40 portfolio counting on those bonds to keep you stable, oftentimes that 60/40 portfolio is down like 20%.
Yeah.
So if you were in that outdated strategy, you thought things were great and they weren't, right? On the flip side, if you're very diversified, as many clients should be, then this year you were not up 18 to 20% because it was really seven, maybe 10 stocks in the S&P 500 that were up, some of them like Nvidia, right? We've all heard on the news, up 200% at last look. I saw
Crazy.
200%. That's a
Yep.
large cap company. Meta up 100 and some percent, and those big companies, and those are making the overall index rise. If you are more diversified than those 10, but not necessarily over diversified in 500, then you're probably not up that much. And arguably, your portfolio should be right less volatile, less movement up and down. That might be exactly what the doctor ordered for you. And longer term, you may be invested in a way where so you've got smaller cap, more innovative names that didn't participate with those larger companies. But over the long term, those some of those smaller, very innovative names are feeding into those big companies. And that's your strategy. That's more aggressive. Those may very well catch up. We don't know, right? But when they start catching up, they got a lot of catching up to do. So if you switch your strategy to like, oh, this worked this year, I better pile all into those 10 stocks.
That's the same strategy as buying high and selling low. Sometimes it's really hard to be able to. I mean, you're never timing the market, so it really is hard to determine what a good, not investment strategy. You really have to determine, I think, where you, let me call it this way. Don't you reverse engineer where somebody wants to be when they get to retirement and base investments based upon where they reverse engineered their life to be, not where they envisioned where the market would be. You're never going to know where the market's going to be.
You're never going to know where the market's going to be. That is a very true statement. And you're right. I like that reverse engineering. It's exactly what you're trying to do. And it's a living, breathing thing, right? As things change, you change, but you don't make knee jerk reactions. And some people say, well, a year's long enough. It's not really. If you look at the history of the market, a year is not long enough. You need to have a 5-year time horizon at minimum
Mm-hmm.
in your accounts. And most people don't. It's really hard. Um, so that's my big takeaway for everybody. Have that longer term time horizon. Actually, it brings up another topic. Maybe this is for a different podcast, but I was recently challenged. You know, and I hear this all the time. You can't beat the S&P 500, and there's this proof that you can't beat the S&P 500. They're very dogmatic about it, right?
Right.
And what did I say a couple of podcasts ago? Anybody who's very dogmatic about something, I tend to shy away from. But just to quickly address this, maybe we'll do a podcast on it later. I'm happy to sit down with somebody. It takes a long time to show you. So I do charge for this, but I'm happy to sit down and show, because this is what I did when I was on Wall Street. How do you beat the S&P 500? And the truth is, they are correct. What they cite is that 85% of active investment managers do not beat the S&P 500. That is a true statement. And they're looking at mutual funds.
Mm-hmm.
And I believe if they applied that to exchange traded funds, actively traded exchange traded funds, they would find roughly the same thing.
Okay.
Here's the issue that I have. Once again, you got to dig a little deeper. What do those managers have running against them? Number one, it's not necessarily their decision when to buy and sell. They have a bunch of retail investors who are demanding redemptions, usually when the market is going down at the wrong time, and vice versa, putting in when the market is running up. So they are at a significant disadvantage, and it is not a surprise that they cannot beat the S&P 500 on a regular basis. On the flip side, you as an individual, or you as a business or institution that can make decisions on your own without all the other input from all the other investors, there are strategies that consistently beat the S&P 500. There's consistently beat the Dow Jones Industrial Average. and it's an exercise in back testing, and there's no guarantee that it'll be that way going forward, but
Right, right.
it's
I mean,
it's happened on a regular basis most years, or most 5-year periods, whichever you want to use. You just have to do the research, and the research is hard and it requires a lot of time and effort. That's what I did for a big part of my career. Is
well, it's
and I
interesting
had
how,
other people doing the research. This was the best part, was when I got to the stage where I had other people doing the research, and then I would chip away at their research, and they go back, and I loved it when that wasn't me being the guy with the spreadsheets, so that now I have somebody doing it for me. But there are ways to beat the S&P 500 as an individual, and the Dow, or whatever you'd like to try and beat.
what would be the reason that the advice wouldn't be just invest in index funds then? Just invest in the S&P fund or the Dow Jones or any of the others that are out there. If you're talking about beating it, I'm assuming you're not talking about beating it by 5 or 10%. It's probably just a couple points, isn't it? I mean, in some years you're not even going to be accurate with that. Some years it's going to be down. I've seen the graphs, the people that try to do it. It's like, hey, I'm a little bit above it or I'm a little bit below it, but what would be the argument against just investing in index funds?
There's not an argument necessarily against it. The argument, especially for somebody who just doesn't want to do anything else, right? You don't want to
Right.
have a professional manage it, and the reason you have a professional manage it, even if you believe that way, you tell them, I want to invest in the index funds, but I need to have my assets allocated and diversified, so that in a year that the S&P index is down, I'm not down that much, right? So you do need your professional for that. But if I can outperform, not every year, but if I can outperform by even 1% over 30 years,
Mm-hmm.
that accumulated difference is a pretty big number. So that's my big argument over individuals attempting to beat the market and using some time tested strategies to do that.
Well, also keep in mind for those that are out there that are thinking about, well, maybe I'll just do the index, I'll just do it myself. It's like, no, you might want to do that for like a week. and then what happens to the other 29 years, 11 months and 28 days, 22 days or whatever it is? I don't want to, because then I got to track it. Then I got to follow it. Then I got to worry about it. I'd much rather have John worry about it every day. I don't want to have to be the guy worrying about it. You have your shoulders. You look like you could handle a lot of responsibility there, John. You okay with your clients and doing that?
I am absolutely okay with doing that. Again, it's what I do every day, and I like it. So, um, yeah, and that's the thing too. Really, really, do you really want to take on full on risk of just the S&P 500?
No, no, definitely
Probably
not.
not. Not most people. I mean, you might think you do for a while.
No, nobody wants to do that. Nobody wants to become an active day trader. If you're listening to this program, you would like John to take care of it. John, what is the best way for them to get in touch with you and reach out and connect with you and your company?
Best way is to go to the website Guardian Rock Wealth, with a TH, wealth, guardianrockwealth.com, and there's all kinds of information there, as well as a contact us page. I'll get back to you. Just pop your information in there. I will come back to you, and we can have a conversation. Next best way is to text the word life, LIFE, to 321-421-5213.
You were leaving me
Text the
hanging
word.
there for a second. It's like, did you
Making
forget your
sure they
number?
wrote it down, right?
Got it. And if you forgot all of that stuff, all of the information and access to John will be right there in the show notes. John, thank you so much for sharing your expertise and wisdom on the show today. Remember, if you're out in our audience, continue building your life, your best life, and we are here to help you do that. Not just your portfolio. Let's build your life. Talk to you soon. Thanks, John.
All right. We'll see you soon.